As a trader, you need to know what the markets are going to do before they do it. In this video, I'm going to teach you a skill that does just that. Okay, so in this lesson, what we're going to cover is everything that you absolutely need to know about time frames in trading. This is super important stuff. What we're going to cover are why are time frames important to trading, what do different time frames represent in real-world trading, and how can we use time frames to predict market moves. Those are the three main things we're going to cover. So let's get right into the material. So why are time frames important? Well, all relevant market information is represented through different time frames on a chart. Regardless of news predictions and general fundamentals, the price action represented through charted time frames is the bottom line of all markets. So by accurately understanding the forces behind different time scales in markets, you can begin to anticipate the possible intensity and follow through of different opportunities. And this will ultimately lead to one of the biggest edges that you can have in trading. Understanding time frames and multiple time frames and how they work together will give you insight into all the players in the market, and it will ultimately help you understand where those future markets are headed. Okay, so now I'm going to introduce you to a concept that we teach here at Trade ATS. We call it the scale of time frame interest. So in this scale, you'll see on the left you have what's called fast small money, and on the right you have slow big money. Now the fast small money is going to be the smaller traders that operate on the shorter time frames, that push those time frames around, meaning the minute 1, the minute 5, the minute 15, up to the minute 30. The slow big money, the people that really trade heavy in the market, are going to be operating on the hour, the 4-hour, the daily, the weekly, and the monthly, and on up from that, because they have a much bigger time frame that they're looking at to place those trades. So let's break down these two groups so you can really understand who's operating on these two different levels. So the first group we're going to talk about is the fast small money. Who makes up this group of traders? So this category includes the majority of retail traders using high-frequency, short-term trading systems and strategies. And when I say high-frequency, I'm not talking about high-frequency trading like the big server rooms located next to the exchange doing thousands of trades per second. What I'm talking about is their strategies usually include multiple trades per session, so they have a high frequency of manual trading operation. So this group also includes market maker algorithms facilitating business between small retail customers. So that matchmaking algorithm between all those smaller traders done automatically, that's also going to act as a floodgate of liquidity on this level, and there's some control in there. The characteristics of this group, it's a short-term approach to the market. They're usually in and out, usually in under 1 day. They trade relatively low lot sizes, so they don't have an overall individual impact on market price fluctuations, and they're able to trade at market with almost no execution problems or slippage. So when they want to get in a trade at a lower lot size, there's no problem with liquidity. They click the button, they're in. When they want to get out, they click the button and they're out right away. So who is slow big money? This category includes institutional traders, money managers, hedge funds, and some well-funded retail traders who collectively make up the market-moving class. Their characteristics, they usually have a longer-term approach to speculation and trading, usually days to months, not minutes to hours. They regularly move large amounts of money in and out of markets, and this is really important right here. They must consider available liquidity before executing a trading plan. I'm going to say it one more time. They must consider available liquidity before executing a trading plan. It's not so easy just to jump in and out. They trade large enough positions to influence market movement, meaning when they dump a huge amount of money or they need to move a big amount of money, that can have an impact on that immediate price. So they have to take that into account before they do it. So this leads to the inevitable question, what category do you fall into as a trader? So most people watching this video would probably fall into the fast, small money category. So to truly learn how to trade, you must understand both categories. What do I mean by this? To accurately forecast future market movements, you need to think like big, slow money, even though you can't individually move markets. Ultimately, to win at trading, you'll need to base your trades from where the bigger money is flowing. You need to know when the small, fast money is about to be overcome by the bigger, slower money, and that's where your best entry timing will come from, and also the follow-through on all the trades that you take. When you align yourself with and you understand where that big, slow money is driving the market, it makes trading on the smaller time frames much, much easier and much, much more productive. So how does big, slow money trade? So when trading huge amounts of money or moving huge amounts of money out of utility, traders do not have the ability to jump in and out of the market on a minute-by-minute basis. So if an institutional trader is working with large enough amounts of money, they risk moving the market too much at once and losing huge amounts of money on a single trade. This would imply that their trading has to be somewhat covert for them to actually do it successfully. So all trades must be planned in such a way as to allow time for execution and the following liquidation of their positions at higher or lower prices. So these forces, this is important, these forces can be accurately classified and monitored through viewing the market through higher time frames. So let's look at some examples. Examples of different time frame representations. On your 1 minute and your 5 minute chart, this is going to be mostly retail traders looking to capitalize on small market movements, usually last no longer than 5 to 30 minutes on average, give or take. On your 15 minute, your 30 minute, mostly retail, some institutional traders looking to capitalize on daily swings, bigger moves intraday. Most trades are going to last from 30 minutes to several hours. In Forex, though, these positions are usually going to be liquidated by the end of the New York session, meaning they don't want to hold any risk overnight. Your hour 1, your hour 4, and your daily is going to be mostly institutional traders looking for optimal trade placement for executing large trades. Also key in moving money for international business purposes. And now we come to the most overlooked, underestimated time frames by shorter term traders, the weekly and the monthly. These represent the collective fundamental money flow of the market. The sensitive points on these charts provide opportunity for huge transactions on the interbank level. A lot of short-term traders say, why would I look at a weekly chart when I trade a 15-minute? Well, if you understand the direction of the week, how are you going to treat that day or the days during that week? Or if you're trading on the daily, if you understand the direction of the month, which side are you going to be heavier if it's in line with the monthly or if it's out of line with the monthly? Simple questions to bake it down for yourself and help you get on the right side of the market. So a lot of traders overlook these, but these are really the true fundamental flow of the market, and you should always have an eye on these time frames. So how can you use this information to your advantage? Well, the first way it's going to help you is it's going to increase your win rate. By basing your initial analysis on the larger time frames, you align your strategy with those who move and control the market. You don't want to trade against these people, you want to trade with them. Let's take a look at an example. On the left here, we have a daily chart. You can see it's clearly trending upward. A totally clear trend formed in the bottom. Higher highs, the classic definition of an uptrend, right? On your hour, you see the daily money movers are stronger than the hour 1 money movers. So every short move on the hour chart becomes a buying opportunity into the daily direction. You would not understand this if you didn't understand there was a clearly defined trend on the daily chart. That's powerful information. That's really powerful information if you keep it basic. So how else can you use this information to your advantage? You're going to get a better risk-to-reward ratio on your trades. By identifying more significant trending movements and turning points, you set yourself up to take advantage of potential low-risk, high-reward opportunities. The best of the best trading opportunities is what we're talking about. Let's take a look at another example. On the left, you got your weekly chart, meaning every bar is representative of 1 week of price action. On your right, you got a 4-hour chart. So these would be a good pairing together to trade the 4-hour into the weekly. Now, the weekly is much more powerful than the 4-hour because it's a higher time frame. This means it can be used as a stable indicator for trend direction, providing you with your directional bias. Something we teach at Trade ATS is your directional bias, meaning that when you have a clear defined trend on your higher time frame, whether it be long or short, in this case that weekly chart is clearly short. That means that we are only looking for short opportunity setups because those have the possibility of not only putting us in the money, but paying us big. So, which leads to the next thing. By trading with the bias to the weekly chart, you set yourself up to have more winners than losers and much more profits when right. So you actually set yourself up to really knock it out of the park on these trades if you stay in that directional bias, and you can only achieve this by understanding multiple time frames. So the next way this is going to help you is your trade time expectation. How long is the trade expected to last? When you pull the trigger, do you expect to get paid in 5 minutes? Do you expect to get paid in an hour? Maybe in a day? By analyzing your higher time frame, you can more accurately forecast an expected time fulfillment to each opportunity that you take. Let's take a look at another example. On the left, you have your daily chart. You're using the daily as your directional bias, and it's clearly telling you to only sell the market. We're staying away from the long side of the market. On the right, we have a 1-hour chart. Okay, you've spotted an entry on a counter trend expansion as we teach in our basic strategy. You see that contraction phase, that box forms, and we get a expansion to the long side against the daily. That's an entry. Now, because the daily time frame must continue trending for this trade to work out, you can confidently say that the total opportunity shouldn't take more than a day or two to follow through and put you in the money. So you're entering on that 1-hour chart, you're trading in those daily candles. If you're going to get paid, it shouldn't take more than a day or two. So it definitely helps you with the expectation of how long, how much rope you should give a trade as you see those daily candles form while you're waiting for an opportunity to pay you. And the last way you could use this information to your advantage is with expectation and preparation. Understanding what the different timescale trends are will help you to focus on where the money flow is and plan accordingly. Another example, short-term traders looking for smaller moves during the London-New York session, you guys can look for the daily and the weekly trends for perspective. If you clearly understand the direction of the week, then you can be prepared for the majority of the big in-session moves to unfold in the same direction throughout the trading week. So that weekly and that daily, those daily trends, you wait for those to be clear, and when they are, then you know when those, that 15-minute, the hour, the 4-hour, when those charts set up, you know that the heavier, the bigger moves are going to be in those weekly and daily directions. That's insight right there. Longer-term traders looking for bigger moves lasting multiple days or weeks can look to the monthly for perspective. The current direction of the monthly chart will tell you where all the big money is flowing. By understanding this basic fact, you can anticipate massive opportunities that set up on the daily time frame in line with the monthly direction. So when that daily, if your monthly is clearly going up, but the daily is going down, that means that you should get ready for it to go up again. Because remember, until the monthly turns, that daily is coming around at some point, and it's going to fall in line with that monthly direction because the monthly isn't done yet and it's more powerful. Very basic things to help you anticipate what's going to happen. So before we wrap it up, I want to give you a couple of helpful tips. So the first tip is regular candles can be a bit noisy. Okay, so if you're looking at regular candles, they can tend to throw you off the scent of the trend too early on your larger time frames. To remedy this, in ATS, we use Heikin-Ashi candles to smooth the market out for a better defined trend. If you're using our software, this is already going to be standard in there. If you're not using our software, then we would suggest you can download Heikin-Ashi candles on the MetaTrader 4 website. If your MetaTrader 4 didn't already come with them, which they usually do. But use these candles at least on your higher time frame because they're infinitely better at keeping you in trend and not throwing you off right before it takes off. Our second helpful tip, if you can't make sense of your higher time frame, stay out. Most of the time when markets are unreadable, it means they're in the contraction phase on an even higher time frame. Wait until the market starts to expand for more consistent follow through. If that higher time frame is whipping around like crazy, it's probably going into a box. It's going into the contraction phase. Wait till you get into the expansion phase and it matures. Wait till you have the clear defined trend. If you could do that one thing by just waiting for that clearly defined trend, then you're 90% of the way to being a profitable trader just off that one simple thing. So pay attention to that. In conclusion, the facts are we need clearly defined trends to follow to make consistent gains over the long run. Consistently profitable days come from trending weeks to back them up. Consistently profitable weeks come from trending months to back those up. If you stay disciplined to the trend long enough, then those weeks and those months add up to a career. I hope you received some value from this and some new understandings. We'll see you in the next lesson.